We want to be in the business of planting a smaller number of seeds, but planting them deeper, and not planting a ton of seeds, but planting them in a shallow fashion, right? That's maybe a bootlegged metaphor here, but we would rather go really deep with a list of properties that we really want to buy versus getting a wide, a list of a lot of properties that we kind of want to buy.
Your host, Rod Khleif.
What's going on, everybody? Welcome back to the Lifetime Cash Flow Through Real Estate Investing podcast. I'm Axel Ragnarsson. I am not Rod Khleif. But as you've probably heard on one of these last couple of episodes that have been released on the podcast feed, I'm going to be joining the podcast every once in a while to talk about direct-to-seller marketing, prospecting, and finding off-market multifamily deals just at a high level. And every once in a while, I'm going to do a solo training type of episode, and that's what this one's going to be here. And in this episode, we are going to be talking about the 5-step process that multifamily investors can follow to put a deal under contract direct to seller in the next 90 days. So a little bit different than buying a property in the next 90 days. That would be challenging given there's obviously the closing timeline associated with buying a multifamily asset. But in this video, what we're going to talk about, or in this episode, I should say, what we're going to talk about is how you can actually start marketing directly to sellers and to do so in such a way to where you are putting yourselves in the position to actually tie up a property, to put a property under contract in the next 3 months, in the next 90 days. So what I'm going to do here is run through these 5 steps. I'm going to spend a little bit of time within each step to actually dissect what I'm talking about. I'm going to assign some time frames to these steps as well in terms of when you should be completing them and how long it should take you to complete them. And then I'm going to round it out in the end with some final thoughts here. But let's get started with step number 1, which is you need to very accurately define your acquisition criteria. And when I say acquisition criteria, I specifically mean where you want to buy properties, right? The location in which you are going to be marketing and looking for properties, the type of asset itself, and there's all kinds of different qualifiers around the asset in terms of size, in terms of year built, all of that stuff, which we'll get into. And then the business plan associated with the property or the project that you want to pursue. So let's start with location here. Just talking about an MSA or a city oftentimes is not going to be enough as it relates to marketing directly to owners, especially when you're just starting to go down this road. If you are new to marketing to owners, new to marketing directly to sellers, prospecting to sellers, you need to have a pretty clear definition of exactly where you want to be doing so. So for example, let's say you are somebody who is investing in the Tampa MSA. You want to invest in Tampa, Florida, the Tampa area, right? It's a pretty vague, high-level definition of where you actually want to buy. That said, there are a number of neighborhoods and zip codes that comprise the city of Tampa, Florida. And when you're going to start marketing to owners, you need to really clearly define exactly where you want to be buying properties. And that's extremely critical early in the process because you want to make sure your time is best spent. You want to make sure your marketing dollars are best spent as it relates to where you're actually pursuing deals. So from a location standpoint, you shouldn't just be looking at it from a high level as it relates to the city that you want to buy in or the state that you want to buy in or the county. You should be getting pretty granular as it relates to the zip codes you want to be in. And in general, you should be putting yourself in a position to when you pull your data list, which jumping ahead we'll talk about next, you have a pretty clearly defined list itself. Next, as it relates to asset, you should be very, very clear on exactly what you want to buy from an asset size standpoint and a type standpoint. So for example, you can categorize based on unit count in the multifamily space. So let's say you want to buy small to mid-sized apartment buildings. That's what you're financially able to buy. That's what you're comfortable pursuing from a deal size standpoint. So let's say you want to buy 5 to 20 unit multifamily properties. Or let's say you're a little bit more experienced, but you haven't done anything direct to seller and you want to look at stuff that's a little bit bigger. Maybe you're looking for 30 to 80 unit properties, right? And you're starting to define your size range in a little bit of a larger fashion, right? You're looking for slightly larger deals. But you want to make sure that you're defining the unit count range of what you're pursuing. And you also want to make sure that you're defining the actual physical type of asset you're pursuing. So there's a couple of different things here. Year built. Let's say your target deal is something that's been built in the last 50 years, right? So you're going to look for stuff that's built from the 70s all the way up till now. You get a pretty wide criteria. Well, you should still define that in your acquisition criteria so that you can filter that in a data list, which we're going to get to. You should also be defining exactly what type of construction you want to buy. Now, again, beggars can't be choosers in a lot of markets, right? Maybe there's not going to be enough inventory in terms of where you're actually pursuing deals for you to be getting that granular with what you're looking for. There's garden style, there's mid-rise, there's high-rise, there's walk-ups. If you're in, New York City, for example, there's anything from 2 to 5 story walk-up type buildings. But if you want to start getting granular there, this is where you're going to do so in terms of defining it within your acquisition criteria. And then you could try to define a little bit further than that if you really want to get specific. I think anything more than that in terms of marketing directly to seller or directly to sellers or communicating this to deal finders in your marketplace might be a little overkill in terms of like flat roof versus pitched roof, stuff like that. But in general, you want to define the type of construction that you want to pursue. For a lot of folks, this is like, I want to buy stuff built in the 70s, 80s, or 90s that are garden-style apartments or, ranch-style concrete block construction if you're in Florida. Whatever it is, you should define it. Lastly, you should define the ideal business plan, the type of project that you want to get into. A lot of people talk about buying value-add multifamily, which has a whole slew of different definitions to different people. There's anywhere from light value-add to moderate to heavy value-add to significant redevelopment where you're actually knocking down portions of a property and redeveloping into some other use or something along those lines. And it's important that you define what you're pursuing in that respect as well. So, for example, in our business, we like to look for light to moderate value adds, which I define as anywhere from $5 to $20,000 per unit in renovation spend. And that doesn't include like a significant re-tenanting of the property where we're taking a property who has or is currently occupied by a number of C and D class residents and bringing it to an A or B. That gets you into the heavy value add space because then you have a management component to it in terms of the value add. You have a significant renovation spend, and you're working through a lot of different things. So in our business, we like the light to moderate stuff. And again, you may be open to buying a lot of different things, and that's okay. But you should still define what's most ideal as it relates to the types of deals that you want to pursue. So an example of a very accurately defined acquisition criteria would be as follows. Let's say you're in the Tampa, Florida region, and you say, I want to be in, I don't know Tampa this well, so I'm going to maybe botch this, but you might want to be in, southeast and southwest Tampa in these specific zip codes. You want to buy properties that are between 5 and 30 units in size that are ideally concrete block construction, but for sure that have been built in the 70s, 80s, or 90s. And you want to buy deals that have a light to a moderate value add component to them and are not going to be really significant repositions. An example of a poor acquisition criteria would be, I want to buy multifamily in Tampa. Like, that's not very descriptive. It's going to be very hard for people to associate what they have if they're a deal finder. And if you're going to go out there and buy a data list, that's also a very wide criteria. It's going to be hard to filter that data list effectively. So you're going to be putting yourself in a position where you're not associated with a specific type of deal that well, and that's going to be a problem. So a step up in terms of something that would be a little bit better, right, in terms of the spectrum here would be, I want to buy 5 to 30 unit properties in Tampa. Still vague, a little bit more defined. And again, you work your way down the spectrum into what I previously mentioned, which is these specific sectors, this specific size range, this age range, this type of construction, etc. So that's step number one, is very accurately defining your acquisition criteria. And this shouldn't take you any more than, a few days, right? You should be getting this done within just a few days. Step number two is you're going to actually go out there and buy a data list that you are then going to use to actually market and prospect directly to owners. So this is where we're pulling all of the information from any various number of sources. I'll share them in a second. That list the property address of which we would like to buy. It lists the owner's name or owner's entity. It lists the owner's mailing address. And then once we skip trace that list, which I'll share in a second, it has the owner's phone number and owner's email, right? So we have a few different pieces of data that we can leverage and that we can utilize to actually get in touch with the ownership group or the owner themselves. So now that you have your acquisition criteria, you're basically downloading that on your data list. You have your zip codes, you have your neighborhoods, you have your unit count range, etc. You have all of this stuff effectively defined. So now we go over to any number of data sources. I'll just list a few of them. You have list source, You've got PropStream. You've got Reonomy if you really want to spend a couple of dollars and sign up for a subscription. You can ask somebody for a co-star list or sign up yourself. I mean, that's probably going to be cost disadvantageous if you're a small multifamily investor and you don't have you don't have a ridiculous budget to pull off of. But you can ask a real estate broker, a mortgage broker, somebody in the industry to pull a list for you. But long story short, our objective here is we want to get a data list. And those are the different areas that we're going to go to get it. Now, some comments here. You don't just want to buy a data list of your acquisition criteria without any filters around ownership. Because again, our objective when we're marketing directly to owners is we want to get in touch with folks who have some level of motivation, who have some desire to sell above and beyond just what a standard owner would have. And there's all kinds of different motivation, which I'll probably be doing an episode on this specific topic at some other point because it's a very deep topic. But at a high level, people are motivated to sell based on numerous lifestyle changes. They want to retire. They just don't want to be in real estate anymore. They want to go and invest that capital elsewhere. They have some partnership challenges. Maybe they're going through a divorce, something like that, right? There's all kinds of different motivation, but the most common type of motivation is, I'm old, I want to retire. That's typically going to be who the seller is in most of these situations, over 50% of these situations, at least in our experience as investors that have done this for a while. So you want to filter your data list to exclude properties that have been bought in the last, call it 3 years, 4 years, 5 years. And this is going to depend on how filtered you want your data list to be. If you are in a small market and let's say the number of properties on your list without any filters as it relates to ownership is only like 100 properties, like you're just doing this in a small town and you're going to start marketing in a small town, small region, small neighborhood, well, you probably don't have to add any filters based on ownership because you have such a small list anyways. But let's say you have a wider range. Let's say you are that investor that is truly interested and really wants to buy literally anything located in any neighborhood in Tampa, and you pull your 5 to 30 unit list. Well, there may be a few hundred properties on there, 400, 500. I don't know. I haven't pulled it, but it's probably going to be a larger number in terms of the individual assets that fall within that criteria. And that's a bit of a bigger list. You're probably going to be spending some money and time marketing to that list that could be better spent elsewhere because you're going to be getting in touch with folks that maybe bought the property a year ago. And they're like, dude, I just bought this. I have no interest in selling it, right? It doesn't make any sense for me to sell it. You're only offering me what I paid. I'm going to pay transactional costs. Doesn't make sense, etc. So in that situation, you want to add some of these ownership filters to it. You want to exclude properties sold in the last few years, which increases the likelihood that everybody on that list is going to be interested in selling. Or maybe not interested in selling, but interested in at least hearing an offer or able to sell at a price that makes sense for you, which would likely be at a discount because they've owned it for a period of time, probably have some equity, etc. And again, the more years you exclude in terms of recent sales, the more filtered your list is going to be, the more likely it is that the people on that list are going to be interested in selling or at least hearing an offer. So for example, if you want to get extremely granular, you can filter no sales in the last 7 years, 8 years, 10 years. And maybe that's the best case scenario, or that's the best approach for you if you're going to be marketing in an area that is very dense in terms of the number of properties that are there. If you're in Boston, Massachusetts, if you're in a New York City, if you're in Los Angeles, right? I'm just naming big cities here. But if you pull all the 5 to 30 unit properties in those markets, you're probably going to get a very large list, and you're going to have to filter that down in such a way that it's approachable in terms of what you can actually do there. So in general here, you're going to take your acquisition criteria from a location standpoint, from an asset standpoint. Some data providers are going to let you maybe edit it based on construction, based on some of those, those other components to it, year built, etc. You're going to put that in your list, your data platform of choice. You're going to filter based on ownership to get to your desired list size. And then at that point, if your data provider isn't giving you emails and phone numbers, you're going to do what we call a skip trace. And there's all kinds of services that are available to help you skip trace in terms of the actual process of finding the name, not the name, but the phone number and email for all of the ownership names on that data list itself. And we need that because that's how we're going to go out there and get in touch with these folks. So Lead Sherpa, batch leads are a couple. If you Google real estate skip tracing, you're going to find a dozen results. They're all relatively similar. If you do use a CoStar or Reonomy, oftentimes they will provide that data for you, so you won't have to go do that. But if you're using a pay per list service like a list source or a PropStream or something like that, you probably will need to go and do that. So let's recap the first two steps here. We have defined our acquisition criteria extremely diligently and in a very clear, very plain English, very clear. There's no, we're not going to have any misconceptions about what we're looking to buy. We have bought a data list and we've skip traced it, so we have all of the information we need to go out there and actually start marketing directly to owners and sellers. And again, the closing comment with step 2 here, anybody who is marketing direct to seller, direct to owner, is only as good as their data. So you really want to make sure that the data that you have is data that you want and data that you feel confident in marketing and prospecting to. So really make sure you get this step right, or else you're just going to be either wasting money on marketing or wasting time on prospecting. Now, step number 3, depending on your time and your budget, you're going to pick 2 marketing strategies. And again, I'm going to outline a handful of these. So we have direct mail marketing. That is you spending money as an investor in blanketing a larger number of individuals with marketing material that conveys the messaging and tells them that you want to buy their property. You are basically paying for leads. You are exchanging dollars for leads. If you don't have a big marketing budget or you have the time to prospect, you can cold call, you can cold text, you can cold email, or you can do some combination of those things, right? But again, what we want to do here is we want to pick 2 strategies because it's easier to stick with 2 for a longer period of time, and it's easier to learn 2 and become proficient at 2 in the beginning, obviously, comparatively to doing a bunch of these, 3 or 4 or more. And doing just 1 is not going to put you in a position to where you are actually having conversations with sellers at a level high enough to actually put yourself in a position to put a property into contract in the next 90 days. So let's say you love being on the phone. You're not intimidated by the idea of cold calling. You have the time to do it. You have the desire to do it. You pick cold calling as one of your strategies. Now you need to pick another strategy to pair with that. Let's say you have some level of a budget, right? Your list is 300 properties. You're willing to spend $100, $1 per mail. So you're going to spend $300 a month on marketing to that list. All right. So then that's a good situation to be in. You can send your 100 direct mail or your 300 direct mail pieces at $1 each. You're going to spend $300. You're going to get in front of these owners via direct mail. But then you're also going to cold call and increase the likelihood that you are hitting them in multiple different ways and making it more likely that you're going to have conversations with sellers. That's one version. Let's say you have $0 to spend on marketing. You just have no ability to spend money on marketing. All you have is time and energy and hustle. You can cold email them and cold call, or cold email and cold text. Let's say you have plenty of money to spend on marketing, but you just absolutely hate the idea of cold calling. Maybe you're just going to spend, you're going to filter your list a little bit differently. You're going to basically build out a list that has a higher number of properties on it. You're going to send your direct mail to that list, and then you're going to send cold email or something like that that's less confrontational. Regardless of what your approach is, here's the process that needs to be followed. Early in the month, you're going to reach out with one of your chosen strategies, whether that's sending a direct mail campaign, whether that's emailing all of the owners, whether that's cold calling. And then later in the month, usually around the 7th to the 15th, at least in our business, you're going to follow up with your other channel, and that's going to reference your first attempt at contacting them. Hey, did you receive my direct mail letter? Hey, did you receive that email I sent you? Hey, did you receive that voicemail that I left? Whatever it is, you want to reference it and you want to start building on what you've already done to establish more commonality and to plant deeper seeds with the owners that you are actually reaching out to. All of this should be done. I'm talking steps 1, 2, and 3 in terms of you're defining your 2 approaches, actually working through that first contact. This should all be done within 7 days. And that second contact with your second chosen strategy should be another 7 days later. You should be 14 days in at this point in terms of completing steps 1 through 3. And the reason that we want to compress all of this in as tight of a timeline as possible is because the success that comes with going direct to seller and doing all of this comes with time. It compounds with time. You need to put yourself in a position to touch these owners 3, 4, 5 times over the next 90 days to put yourself in a position to have quality conversations and to put a property under contract. and to at least increase the likelihood that you've earned the right to get a deal done here, right? If you only send one round of direct mail in 90 days, you have not done nearly enough to get a deal done. If you send one round of direct mail and you do one round of cold calling in 90 days, it's a little bit better. But still, you have not done enough to put yourself in a position to get a deal done or put a deal under contract. If you send the direct mail and you cold call each month for 3 months, that's 6 contacts. You've now extended just a lot of, you've put in the work here, and you've extended the time horizon of what you've already done to a point to where you've done it over 90 days. You've done it twice a month. That's 6 points of contact. And assuming your data is good, you are now in a position to have had conversations, and you are already probably speaking with owners throughout that period of time. So to recap step number 3 here, depending on your budget, whether it's time, money, pick 2 strategies and get that first round of communication out, whether that's spending money on direct mail, whether that's cold emailing this list, whether it's cold calling everybody on the list, within that first 7 to 10 day period of time. And then you want to make sure that a week after that, you are going back to your list and you're spending it again, whether it's you're now mailing and you want to follow up on your cold call, whether you're emailing and following up on your piece of mail, whatever it is, you are now going out to your list with that strategy and referencing what you did the week prior, so that you're building you're building some level of familiarity with all of the folks on your list, and you're planting deeper seeds. Again, just as a high level comment here, we want to be in the business of planting a smaller number of seeds, but planting them deeper, and not planting a ton of seeds, but planting them in a shallow fashion, right? That's maybe a bootlegged metaphor here, but we would rather go really deep with a list of properties that we really want to buy, which is what we touched on in steps 1 and 2, versus getting a wide, a list of a lot of properties that we kind of want to buy. Because again, when we have these conversations, we want to put ourselves in a position to aggressively pursue these deals. Obviously, we want to buy great deals. We want to buy a discount below market deals, but it's often going to be the situation where you can more aggressively pursue the deals that very closely align with your acquisition criteria. Not only that, you're going to be significantly more emotionally invested when a seller that really fits your core list calls you after they receive your direct mail piece, because you really want to buy that property. You're going to be less emotionally invested when some guy calls you who's got, a 5 unit, but you really want to buy 10 to 30 units. It's a little smaller than where you want to buy. It's also in a market that you don't really know that well, because you just kind of are blanketing this whole metro. You're not going to follow up with that lead as effectively. You're not going to spend as much time on seeing that lead through. And therefore, it's making it harder for you to actually do a deal, put a property under contract, right? Which is why we're doing all of these different things. So to recap the first 3 steps, we want to very accurately define our acquisition criteria. Step 1 should be done within a few days. Step 2, we want to go buy a data list filtered from an ownership standpoint in such a way that gives us a list that we feel confident pursuing. That's step number 2. Again, that should only take you a couple more days. We're a few days in here, 5 days in. Step number 3, we want to pick our marketing strategies, or our marketing and prospecting strategies. We want to pick 2 of them. And we want to start in that first 7-day period of time with that first one. And then again, we want to follow up with it a week later with that second one. That takes us to step number 4, which is we want to begin establishing our local brands. We want to start working towards becoming omnipresent in our local market. This is what we have to do in order for individuals in the marketplace to bring us deals. So this is a little different than a direct-to-seller situation. But again, a direct-to-seller deal does not have to be one where you are the one who reaches out to the seller. There are many situations where somebody knows of somebody that might be interested in selling, and they connect you with them. They say, hey, you should go give so-and-so a call. They're trying to sell this property. Or they say, hey, hey, John, I have this seller who's working with our management company. He's a management client of ours. He's interested in selling, and they actually facilitate a connection. That's still, by definition, direct-to-seller, right? We don't have a broker involved. So again, we need to do what we can to establish our local brand so that we increase the likelihood that people want to bring us deals. Step number 1 in doing this is to reach out to everybody who's active in the multifamily real estate sector in that marketplace, and let them know exactly what your acquisition criteria is and what you want to buy. So we've already done that in step 1. So now it's just a matter of let's go and email all of the brokers that we know in this marketplace. Let's go email all of the lenders and the mortgage brokers we know. Let's go and email all the title companies. Let's go and email all of the property management companies. Let's go email all the service providers, the flooring companies, the electricians, the painters, etc. Hey, John, my name's Axel. I'm currently in the market to buy so-and-so in this market. We really like deals that kind of look like this. If it's a light value add, low rents, long-term owner, that's really something that speaks to us, etc. If you find anything that works for that, please consider giving me a call or reaching out. Happy to throw you a referral fee or a finder's fee. Maybe we can talk about a joint venture partnership, etc. And now you have a bunch of people working on your behalf in addition to you working on your own behalf, going out there marketing and prospecting. So again, the objective here is to share that with all of these different individuals in your network. Once you share it, you should be taking all of the email addresses to all of these different individuals and putting them on an email list. Plenty of services that can help you do this. MailChimp, HubSpot, whatever. Get all of their emails on there and start sending a monthly newsletter that shares your acquisition criteria, maybe some value add market info, all kinds of different publications that can help with that. So, this is the Q1 vacancy rate in Southern New Hampshire's X. The median home prices have increased X percentage in Manchester, New Hampshire by Y, in Q1 of 2024. Average rents grew like this. This business is moving into town. This business is moving out of town. Whatever it is, if you think it would be valuable to you as an owner to know this, you should be putting it in your email marketing newsletter. And then there should also be some commentary at the top that personalizes you with the recipient. Hey, our business just put this under contract. Our business just closed this. We just refinanced this property. We just sold X. Whatever it is, you should be sharing some information around what's going on within your business, in addition to some value-add content, in addition to a reminder of what your acquisition criteria is and what you're looking for. And this is something that you should be sending out on a monthly basis. In the first 90 days, maybe you can't send it out 3 times because it's probably going to take you throughout that first 30 days to get it done. But you should at least be sending it out twice, beginning of that second month, beginning of the third month. And it should put you in a position to have real conversations with the other people that are in the marketplace doing something similar to what you are doing, whether or not they're buying property or not. They're interfacing with multifamily investors and owners, and they have as much of a sense of what's going on as you do, given that you're kind of new to this game and starting to do this from scratch. So again, that would be step number 4 here as it relates to how you can start becoming omnipresent. You are going to go out there and reach out to every potential deal finder, wholesalers, brokers, mortgage brokers, residential agents, et cetera. I listed a bunch. Introduce yourself if they don't know you. Share your acquisition criteria. Share how you can be of value to them as well. If they do know you, you're just reminding them. And then you're taking all of those emails and you're putting it on an email newsletter that you can then send recurring emails to on a monthly basis. So again, we're going to recap the steps. Step 1, acquisition criteria. Step 2, buying your data list. Step 3, picking 2 marketing strategies or prospecting strategies that align with your time and budget, basically how much time you have and how much money you have available to spend. Step number 3 is you're going to begin establishing your local brand. You're going to begin becoming omnipresent in your marketplace. And now, once we get that done, we repeat, and we repeat monthly. And it's important to understand here that when you start going down this road, you need to be comfortable doing this in perpetuity. This is not something that you do for a period of time to get a deal and then you stop. This is a very important mindset shift that you need to make before you even begin going down this road, right? In multifamily, sales cycles are longer. Sellers are going to be motivated for different reasons, and they're going to be motivated at different times. We are in the game of just being top of mind. We are in the game of being around, being available, being the first person that people think of when they think of either A, I want to sell my property and they're a seller, or B, I know this guy who wants to sell a 20-unit building in this zip code or this area of town. I know that so-and-so likes to buy that. I know John really likes buying those deals. I'm going to let him know that, my management client is interested in selling, or my, client, if it's an attorney, is interested in selling, what have you. We're just in the business of constantly being top of mind. We just want to build a mind share over time. Again, you can do a lot in 90 days as it relates to getting in front of owners, right? And in the first 90 days, all of the direct to seller work is going to be what generates the quick leads and the quick conversations and increases the likelihood that you put a deal in a contract. What pays you dividends long-term is becoming the omnipresent figure in your marketplace through all of the things I mentioned in step 4. And that's why we're doing it initially, is because, sure, it may generate some leads. It may help you have some conversations with owners. You may catch somebody in your network at the right time as it relates to a seller that they're working with or what have you. But all of that work is what pays long-term dividends as you build the mind share with all of the players in your marketplace. And all of the direct-to-seller work is the faster returns. And even then, the long-term tailwinds is what happens after you do that for a longer period of time over the course of 6 months, 9 months, 12 months, and beyond. So again, it's critical that while you're coming into this with understanding what you need to do over the next 90 days to start this process and to increase the likelihood that you put a great deal under contract in the next 90 days, it's important to have the patience and the perspective to see this through for 900 days, right? Multiple years. You need to be looking at this through a very long-term lens, because the best deals that you ever buy in this business from a discount to market value standpoint are typically going to come in situations where you have been in contact with an owner for a multi-year period of time. Again, that sounds intimidating because that takes a lot of work and it's a long period of time, and that's correct. But that is the really important dynamic of this, is that when you speak with a seller every couple of months, they get your newsletter, you follow up with them every 90 days, and you do that for a couple of years, an absurd amount of trust and rapport has been developed. And they're almost at the point, at that point, if you've stayed in touch with them for that long, where they're disinterested in what other people have to say, and they're completely interested in what you alone are looking to do here and what you're willing to pay and how you're willing to approach this deal. And again, you just have to earn that right over a longer period of time. And that's why step number 5 is you're going to repeat monthly, ... in perpetuity. And once you commit to the longer term focus here, that's when you really start to see the deals. But everything I talked about in this episode is going to be applicable in the short term as well. And that's also important to know. That's it for this episode, though. I appreciate you guys listening. I'm hoping that you took something away from this. And again, if you're looking to learn more about direct-to-seller marketing, finding off-market multifamily deals, stay tuned for other episodes that are similar to this, where I dive deep into specific topics, whether it's related to direct-to-seller marketing and prospecting or other components of finding great off-market deals at a discounted price, which is obviously our objective as multifamily investors. But thanks again for listening. I'll catch you guys on the next episode.
So one other quick thing. We encounter so many people that are frankly frustrated. They're looking in the mirror and they're frustrated that they haven't been able to escape the rat race. They haven't been able to build cash flow to the point where they're able to have financial and time freedom with their families. And maybe they see other people buying real estate and creating, incredible cash flow, and they think, well, it's just scary. Buying apartments is intimidating. And I get it. See, that's why we created our Warrior Mentorship Program. They're our coaching students, and they've had extraordinary results. My students, I've been teaching about 5 years, and they own upwards of 140,000 units now that we know of, right? And we feel like it's just getting going. Now, we're looking to grow this group and really take it to the next level. And honestly believe that the greatest transfer of wealth could be upon us right now with this current economic environment. Everything's going on sale. So we're looking for people who want to follow a proven framework, really like a blueprint or a map, literally step by step. And then they're able to leverage our systems and our incredible network to raise money and equity, to find deals and close those deals and build partnerships, really nationwide. So if you're interested in finding out more about how you can become more in our incredible network and take advantage of the unbelievable opportunities that are upon us, you can apply to my Warrior Mentorship Program by texting the word CRUSH to 72345, or you can go to mentorwithrod.com. And what we'll do is we'll set up a call so you can check us out and we can check you out and see if it's a fit. Now, again, you can go to mentorwithrod.com or text the word CRUSH to 72345 to apply, and we will speak soon.